this, I mean, what my point is that you could be sitting on massive unrealized gains or unrealized losses, but until you press the sell button, none of that is real, so to speak. But the dividends that you receive in your bank account, whenever they give out the dividends, yeah, I mean, that's your realized profit, so to speak. Even if the stock were to crash the next day, or in 10 years' time, or in 30 years' time, yeah, that is money that is in your pocket. Yeah, that's what I meant. I'm not saying that dividend stocks trump growth stocks, or growth stocks are way better than dividend stocks. Yeah, nothing along these lines. Yeah, that's what I meant.
Yeah, actually, just now I text A also, like just private message him. These words are talking about like, okay, regardless of how much your stocks has went out, right? It could be like 3x, 5x, right? As long as you haven't click the sell button and cash out, right? You still never know that this is a gain, right? This exact phrase, right? Actually, the first time I heard of it is actually came from my wife. She said, because sometimes I also report to her, right? For example, like, stock has went out how much, and then she said, hey, sell lah. Then I said, why sell? I'm going to hold it for long term, right? Then she said, you never sell, you never know, right? It could like drop back, right? Even go up by 100%, crash another 50%, go back to zero, right? I mean, in terms of profit and loss. I said, okay, that's true, but as we hold longer, then business grow, and that's the real growth, right? That's the fundamental growth, right? So we also have a bit of debate talking about such things. Yeah, quite interesting also.
Yeah. Actually, I share the same sentiment as your wife. And about the second part where you said, like, why sell, right? I mean, just hold on to it because it should grow even more, as time goes by. But that is an uncertainty. That, to me, that is not guaranteed. Like, a company could be doing well for 20 years, and then the last 10 years, it could just, like get disrupted or whatever, There's no guarantee that a great company, however great it may be, will remain great forever. So, until you press that sell button, you're not, you haven't reaped the profits yet. Yeah, that's what I meant.
Yeah, that's I understand the viewpoint, but we will go into the details later. But I think all right, let me see how many are here. Wow, we have quite a number of people. It seems that people prefer to join evening session rather than morning sessions. Okay, I think thank you very much for joining the session. This session I'm actually recording now, so I will share the recording to YouTube later. But I just want to, because today's there's a very interesting discussion on these topics on dividend stocks versus like non-dividend stocks, right? So I think it's a good chance for me to like just voice my viewpoints on these topics. So I try to not to phrase this to become like a debate on whether dividend stocks is better or not. Let's go into like the details and see what is the fundamentals, or what is the, from first principle, how do we see these things? I think that's my objective of having this call. So Mr. A, yeah, if you don't mind, I'll just quickly go through my what I've been thinking. Like, try to how to say, make it structured a bit for today's discussion. But feel free to stop me anytime if, let's say, any one of you have any things, any opinion or viewpoints. So actually, I prepared like just a very short presentation just to help me explain my thinking. So if you guys don't mind, I will just use these slides. So actually, when we talk about dividends, right, this is how we're talking about like companies. How are they actually using their cash? Okay. So dividends, first, they must have the cash first, right? Then only they can pay out. So if we look at the details, right? Okay. The first one is of course, the first one is, of course, they can invest back into their business. So this is like hire more people, expanding their core business and so on. So these are all like just reinvest. As long as they can achieve a good ROE, reinvest is always good, right? Then the second part, right, is like they can use the cash that they generate and to pay down debt, right, if they have any debt here. And then the third one is, of course, they can grow the business like what Microsoft did, right? They buy another business, M&A. This is also something that it can do. And then the last two, right, which is the share buyback and the dividends, these are after they are not going to reinvest back to their business, not paying debt. What they can do is distribute back the money to their shareholders, right? So these two are actually taking money out of the company and pay it. So they can buy back their shares or they can pay the dividends, right? But all this, right, is like how they use the cash, right? So my viewpoint is that if this is after they have a cash, right? For example, Microsoft, they're already running their business, have tons of cash. They cannot just keep on the cash forever, right? Like accumulate to how much you want to accumulate, right? 100 billion, 200 billions. At some point, they must have a way to actually utilize the cash, right? So they can actually do all any of these five. But this one is after. But before that, right, we need to understand like how they can generate the cash, right? Which is trying to bring up with this diagram here. So what we are trying to say, what I'm trying to express is that first, before you reach the cash, right, you must have a business model at the first place. So you have business model, you have revenue, minus out all the dividends, and then you have the free cash flow, right? Then only you can talk about how to utilize the cash, right? So to me, right, it's not saying that dividend investing is not good or good or not good, because that is the after you run your business, then only you have cash. But in order for us to assess whether the business is good or bad, right? Of course, we can see the stuff that is happening, like after all the business, the activity that they have run, right? If cash is building up, it means that there is something right about the business. That's why they are able to generate cash, right? But the other things that we can also see is before all these activities, meaning that we just run through the income statement from, like, we can look at their revenues, and then we can look at their expenses to make sure that the profit margin is healthy. And then from that, as long as you have the cash, then you can look at whether are they distributing out, or are they using the dividends to do share buyback, or are they reinvest back to the business, right? So this is what I'm trying to say. I think I don't remember who voiced the other opinions. I think it's similar things. Basically, if you are, the companies, whether they are paying dividends or they use the cash to do share buyback, right? Essentially, they are the same, right? Of course, there are some tax implications. Yeah. So I think I'll just stop here just to hear like any comment or feedback. This is basically my viewpoints, whether business is good or bad. Instead of looking at the dividends only, right, the percentage of dividends, right, we can actually just look at other metrics, which also tell us the strength of the business. I'll stop here just to hear any comments. Wait, I'm very scared that every time I stop for comments, no one comment anything.
Yeah. I think there's this dividend payout ratio. Yeah, to see whether the dividends are sustainable. Yeah, because I think you guys have probably heard of what they call dividend traps, right? Yeah, where they pay out a fat dividend for 1 year, and then it's unsustainable, and then but people get suckered into buying that stock because wow, they look at the high dividend yield. Yeah, and yeah, so I think one simple way is to look at the dividend payout ratio. Also, there's this notion that if the companies give out dividends, it means they can't grow, or but if they give out if they give out dividends, that means they are a lousy company. I don't think that this is necessarily true. Like, I think even a great company like, I don't know, Microsoft, for example, I think even if they gave out dividends, they would still be a great company, right? And I think, let's say a stock like Singtel, if let's say they didn't give out any dividends, I think it won't change anything. They would still be in the position that they are today, deep in a rut. Yeah, so I don't think that dividends have anything to do with whether a company is great or not.
Yeah, I think that's actually the point. Sorry, Abun Song. I think that's exactly the point that I try to bring out. Is that, okay, if we just invest based on dividends, right? We say, okay, if the dividend is good, I'm happy, I buy it, I just hold, right? So that's my return, right? And then I think you brought out a good point is that we cannot just look at the dividend. Let's say if the payout ratio is more than 100%, we know for sure this is not sustainable, right? So we can look at the dividend and we look at the payout ratio and use this to judge whether that is a good business or not. I think these are also very valid points. The point I'm trying to bring out is that, regardless of how they play with their this, we call it the capital structure, right? Whether they pay out dividends or not, right? Just looking at the business itself, the revenue, the business model, are they producing a product that the customer likes or not? Just looking at this point without touching on how they utilize the cash, right? We can already know that whether this business is good or bad, or the business that we like or not, right? So, for example, like say any companies that you like, right? Say DBS. If DBS suddenly we buy it because we are thinking that the business is good, and let's say they are paying, let's say 4% dividends, right? Then suddenly they say, I'm not going to pay dividend, I just do share buyback, right? Will they change the fundamental or not? My opinion is that that's not going to change the fundamental because the business is still the same, right? It's just the dividend policy that is changing, right? So to me, if we just look at one company and then just by playing around with the dividend that they pay out won't change the fundamental, because the fundamental is regardless of how much they pay out, right? So that's my point. So yeah, I'll stop here. Boon Song, you try to say something, right, just now?
I can't remember what I want to say, but I heard he mentioned about Singtel, right? I can't remember what did he say about Singtel?
I mentioned that, okay, right now Singtel is not doing well, right? And my point is, they aren't doing well, and it's not because they aren't doing well, and it's not because that they paid out dividends. Even, okay, let's say they didn't pay dividends, right? I think it wouldn't have changed much, they would still be in a bad position today. So yeah, I think there might be this notion that dividend paying stocks are bad, or or can't grow or whatever. But I don't think dividends have anything to do with whether a company is a great company or not. Yeah, that's my point. Yeah.
Yep. But then my question is, if you also think that the dividend is like not so important, right? Which is the point I try to bring out, because you just play around your dividend won't change the fundamental of your business, right? Singtel can stop dividend, their business is still their business, right? Then why, when it comes to investment, you still pay so much focus on the dividend? That's something I try to understand.
Okay. Okay. So like for example, maybe to keep it simple, I'll use DBS as an example. Okay, like you mentioned, let's say they stop giving out dividends. Well then, I guess for me personally, I like to have that. I like to take some profit off the table. You know what I mean? Yeah, you're right to say that DBS will still remain a great business, and who knows? Maybe they could grow even more. I mean, I don't know about that, but personally, I like to take a bit of profit. Rather than letting management take all the profit and then embark on some venture. Yeah, it is not that I'm skeptical of management. I think the DBS management are doing a pretty good job. The CEO Piyush Gupta. Yeah, I think he's quite a visionary. Okay, but at the same time, yeah, I don't see what's wrong with taking some profit off the table. I mean, let's say I run a business, right? Let's say I run a bakery. Yeah, I mean, what's wrong with taking some of the profit of my bakery and maybe putting it into something else? I could even use my dividends to speculate on Bitcoin or Tesla or whatever. Yeah.
I think
it gives me that flexibility. Yeah.
Yeah, I'm just try to rephrasing some of the viewpoints that was mentioned in the chat group, I think this morning or afternoon. For example, you are giving this DBS as an example, right? So you say you take dividends. That is a bit like capital come back to you first, right? So you already take some capital off the table. But another scenario, say Tesla, because Tesla not paying any dividends, right? If I buy Tesla, I bought Tesla at, let's say, $1,000. The share price go up to 1,003. Then I have 10 shares. Then I just sell one share, and I treat that one shares like take the money off the table, right? Become like I pay myself a dividend out of it, right? Still the same thing, right? So what do you say for this kind of scenario?
Yeah. You could do that also. Yeah, you're in a way you're taking some of the profits off the table. Yeah.
Then what's the difference? Yeah. So
what's the difference? Well, I mean, actually, I didn't say there's any difference. Yeah. I guess what I mentioned in the chat group earlier today was that profits, unrealized profits or losses are but an illusion. Yeah, that's it. Dividends are real, or what, as you mentioned just now, you can sell it off, and then that becomes a realized profit. Yeah. So I mean, that's real. That's not an illusion. You sold one Tesla stock at a profit. Yeah. So that's realized. That's not an illusion because it's realized. That's what I meant. Yeah.
Okay, we'll come back to this.
Just like dividends. Dividends are realized profit, so to speak, right? I mean, the money that goes into your bank account, it's there. It's not unrealized. It's there. It's cold hard cash. You can use it for whatever you want. You know what I mean? Yeah,
okay,
you have made the money.
I got the point. Yes, Yixman, you're saying something?
Yeah. So what I believe is that dividends are good if there's a dividend strategy for that company. There are a lot of instances where companies just pay out dividends, or I don't know why that, like, for some reason management decides to pay out dividend because profits are good, with no viewpoint as to why are they paying out a dividend rather than investing. Now, at the heart of most companies, the purpose is that you want to have capital grow and appreciate, so investors need to have value, to realize value. And companies that pay dividends should be doing it based upon like all their entire business is based upon, okay, for example, Coca-cola says that 75% of our free cash flow will be paid in dividends. That is over time, and that has been the case since forever. So they have been doing this, and everyone knows that they're not doing it because I feel like it, or I don't feel like it sometimes. So their business is geared towards paying out this particular dividend. So it is not as if the management is not doing what they're doing. That is where a dividend company might be strong, in the sense that all their management is geared towards actually making a profit in order to pay a dividend. That is where I think a dividend company is strong. But if it's just anyhow doing it, then you get dividend trap companies lah. Yeah, that's what I have to say lah.
Yeah, I think you brought a good point there. This is why also I like try to understand why certain companies or certain investors actually prefer dividends stocks and not the others. I think that the point is that for companies that have to pay dividends, so when it comes to management, there will be a discipline to continue paying that dividends, because they know that if they have been paying a certain amount every year and then suddenly they are not able to generate the cash, right? Then the stock price, and they are not able to pay the dividend, the stock price will tank, right? So they will try their best to maintain the dividend payout as much as possible. So it means that when it comes to, let's say, expansion or anything like doing something that they outside of what they have been doing, right? For example, they want to acquire another companies, they will try to be more careful because there is something that become a commitment, right? That they need to make. then that one I think is good in the sense of like promoting some discipline when it comes to how to manage the business. I think that's a very good point. Yeah, I think that just now we talk about like, okay, if we talk about single company and they just change the dividend policy, I mean, the fundamental is still the same. I think we all agree on that now. But we all know that companies that pay dividends versus those that doesn't pay dividends, also sometimes they are quite different. So I just want to bring out this, when we talk about the face of the companies, right? So they started out from like on the survival, and then they become success and they ramp up, right, in terms of the scaling. And then after they take off, right, they will mature. And then if we look at like list of companies, right, thousands of companies in the radar, right, those that pay dividends, usually they are mostly mature companies now, because if you can just reinvest back into your company and then you can just get a very high ROE, you should just do that, right? You shouldn't just pay out the dividends, right? You only pay out dividends when you cannot generate the same or attractive level of ROE. So that's why I think whenever we talk about dividends, right, then there's always like not always often we'll see two groups of investor. One group is more towards like prefer early, like young companies that are still ramping up, still scaling up, right? Versus the other group of investor who is preferring companies that are more matured, return the capital back to the shareholders, and then basically paying dividends. So this will definitely, I think when we compare different group of investor, those who prefer dividends are more prefer mature companies than young companies. I think this one we can generalize a bit. Not sure whether you guys agree or not. You can unmute and voice your opinions.
Okay, for me personally, I think it's about it's not that no one wants to make money slow. I mean, who wants to make money slow? I wish I could double my money every single day, but the reason why I'm more inclined to dividend stocks right now is because I feel that before I mess around with the more speculative stocks or growth stocks, those stocks with very high PEs, I would prefer to have I would prefer to build up my so-called income stream, Then once I have this income stream coming in every month, I can do whatever I want with it. I have that flexibility. I could double down on my dividend stocks. I could speculate. I would feel like I have some form of I don't know how to call it. Maybe some not really a safety net, but some form of income. So even if my speculative stocks go to hell, I still have, I can still count on my steady stream of income. Yeah. But of course, nothing's for certain. My dividend stocks could also go to hell. Like during the crash of 2020, I sold one of my REITs, First REIT. I think most of you would have heard of First REIT. Yeah. They restructured the master lease or something, and it was terrible. So I decided to sell it at a loss, quite a significant loss. Yeah. So for me, it's building that income stream first, and then having fun, with these so-called growth stocks. Yeah, for me.
Yeah, I think when we are framing it this way, right, I have a feel that, okay, we always have these two groups, right, dividend versus non-dividend. And the dividend one are those like steady one. For example, even we can include tech stocks, right, Apple, Microsoft, these are paying dividends. And then the other group, right, which is like you said, Tesla, this kind of speculative growth stocks, right, they are not paying dividends, right? But to me, it's also like not like just one scale, like exactly growth, no dividend. Then dividend one is like mature, steady one. Because there are companies like Berkshire, right? Berkshire not paying any dividend, but I'm Eddie is here. Eddie can give more comments on this. But I don't think anyone owning Berkshire stocks would think that it is very unstable. This is definitely not growth stocks, right? Yeah.
Yeah,
I mean, it's a very small business, so they instead of paying out dividends, they plow it back, buy back the shares and all that to boost up the share price.
Yeah, so I just want to hear from A is that, well, what do you say for this kind of companies, like stable but not paying dividend? Could it serve as like something like stabilize your portfolio? This is definitely not speculative, right?
I fully agree with I get what you mean. Yeah. And I think Berkshire Hathaway is pretty solid company lah. I wouldn't say Berkshire Hathaway is a speculative company. Yeah, even though it doesn't give out dividends, but yeah, if I were to invest in Berkshire B, I would dare to put a sizable amount of money in that counter. Yeah. But if you're talking about Tesla, I would be very cautious, Yeah. In fact, I was just thinking, from what I've read, Berkshire is sitting on quite a huge cash pile, right? And at the same time, I believe they are growing as well, right? So I was thinking maybe it's if you buy Berkshire, you get the best of both worlds. I would think that if there is a crash, I think they can capitalize on a crash. Yeah. And if a crash doesn't happen, I guess the stock would still continue to go up.
But I think the point that I try to bring out is that what are we like debating, right? Because we keep on saying, okay, dividend versus non-dividend, right? Are we comparing the top part versus the bottom, right? The dividend versus non-dividend, or are we comparing the left versus right? Like young companies versus those mature companies, right? Because if the purpose is to have companies that is very stable, not speculative growth stocks, right? That's sitting in our portfolio, just to make sure that our portfolio is not going to tank 50% anytime soon, right? Because they are like solid companies, right? Then we should just talk about, okay, I would prefer to own more matured stocks, like Apple. These are considered matured, right? And not talking about dividend versus non-dividend, right? I think that's try to like, what are we comparing against, right? Because to bring out the point is that actually what you are saying is you prefer the matured one. That's right? And not so much on the dividends.
I guess between matured and non-matured, definitely I would be more inclined to buy a matured stock. But it would be nice to have dividends as well from these matured stocks, because how shall I put it? When I receive the dividends from these matured stocks, it gives me the flexibility, like I can use these dividends and I can go and speculate. I can go and buy Bitcoin. I can go and buy Tesla or whatever, So it gives me the chance to take some profit off the table while still having that stock in my portfolio. Yeah.
You have 10 shares of Berkshire, you also can sell 0.1 share, fractional shares. Also work the same. Debate, right?
You can say that. Yeah, you can say that.
Okay. So you just, I'm just, okay, not.
I mean,
not trying to debate so much.
Ideally, I wouldn't have to sell anything, and I can still, get paid. Ideally.
Yeah. You prefer to have the cash flow.
Yes. Because it gives me the flexibility, and I can do whatever I want with that cash flow. I can, buy other companies. I can double down on the same company. I can go speculate or buy Bitcoin or whatever, Yeah. So in that sense, I guess it allows me to diversify a bit. Yeah, I guess rather than if I don't get any dividends, then I'm putting 100% faith in management. Yeah, but if I get a bit of cash leaks out, it gives me the chance to diversify, so to speak.
Yep, I got the point. Right. I think just want to take this opportunity to share a bit the reason I myself am I'm not focused so much on dividend stocks. It's also some of my painful experience investing in dividend stocks. So I think I mentioned before, I'm invested in this company called Berjaya Toto. This is a Malaysia company. So definitely dividend stocks. I just want to share this. So, I also have like similar thinking process that you have, like you just shared, right? Prefer to just invest in the companies and then you just sit there, do nothing, and you just keep on receiving dividends, right? But my own personal experience, and also I think this is my fault also, because when I invested, I just keep on looking at the dividends, looking forward for the dividend checks, right? And just not monitoring the fundamental of the business that much. And for years, this is not talking about like 1 or 2 years. This is like more than 5 years I own these stocks. And then it's only until COVID, I think mid-2020, I look at the fundamental and I just ask myself whether these companies still have the fundamental or not. Then I was actually shocked because I haven't monitored their annual statements for so many years. I was shocked with how much they have deteriorated in terms of their real fundamentals, Then I sold it off. So I just pulled out some numbers just to give you some context, right? You see, this is the dividends from 2012 to 2021. It goes up here. I don't know. I don't remember why it went up. I think probably it's because they have some M&A and then they dispose, something like that. I don't remember the details. But just look at the numbers, right? Revenue, they are not growing that much. And then the profit is the one that is very painful to look at. You see, they started from 579 million ringgit and keep on dropping, right? From like in this 8 to 9 years, dropped by half to now only like 282 millions. And then we can also see that of course, this is net earning per share, same as the profits. You can see that it keep on dropping, right? Then the dividends, every time I'm just thinking, okay, why not anyway, I get dividends, right? Like you said, table off, money off the table, right? But as the fundamental of the business drop, right, their dividends also drop. So from, you see, 27 cents now to like 10 cents, 8 cents here. So it's really painful, even though I get some money back and then, but the business is not doing well. So it's overall not a good experience. I'm not saying every dividends paying companies looks like this. It's just that for myself, right, my experience is that I thought as long as I receive dividend, then it's good, right? But then that dividends payment that I have received, right, actually give me a false impression that I'm getting something back. But actually, it is actually drawing the capital from the business. Because as you see here, right, the net earning per share, right, and versus their dividend, like payout ratio is not like their payout ratio is more than 100%. It's actually like, I would say, let's say 90%, 80 to 90%. So the dividend is always less than the earning per share, right? But the fundamental actually drop. You see, what I'm trying to say is that if they have not been paying dividends, I will pay more attention to the share price, right? And if I pay attention to the share price, then I will notice that actually there are something that point me towards like looking at the fundamentals. And you can see this is the share price. Since let's say just I show from 2012, right? It just keep dropping. I saw around this area here. And looking at the fundamental, I'm not expecting them to rebound also. Yeah. So just to contrast this, and I want to go circle back to the point that you just mentioned, right? You said dividend is real because that's something that you cash out, right? You receive dividend, you cash out, right? If a business or if a company that you own, whether it goes up by 3x, 5x, 10x, right? You never know, right? But I just want to say, if you have that kind of mindset, right, it also means that nothing is actually real. What is real, right? To me, the business is the real one. Because if the business has already grown, right, regardless of share price, whether they go up or not, right? But if the business has become better, then that is something that is real. You don't have to like really cash out to see the cash, then only say this is something real. So to illustrate that, I'll just bring in one of my holdings, which is Apple. If you look at the chart, right, they have went up like a lot. Let's say if someone they bought at, let's say, just $10 here, right, $5, it went up by so much, right? Would you say this is real? If I just look at the share price, I will agree with you. Like, you never know, right? They can go up here, they can crash 90%, just go back to zero, right? If we don't know the fundamental of the business. But if we look at the fundamental of the business, right, which you can see. I mean, just some numbers, right? We don't have to like understand the financial statement in details, right? We just look at their revenues from 2009. This is what, 42 billions, right? Now it's like already like close to 10x already. It's already at 365 billion. And you see their net income also like more than 10x, right? And hence the share price also move up. Of course, the share price move up more than the fundamentals. The PE expansion also increased for Apple case now because they move towards service, and then the revenues is deemed as more consistent because of getting into all these service revenues, right? So I think that's explained the PE multiple. But all in all, I try to bring out the point is that this is not all fake, you know. Yeah, the share price has went up and their fundamentals also went out, right? So I would say that this is real. Not to the extent that you say, oh, price move up at 10x. They are all illusion, right? This is not illusion, right? Yep.
Yeah, okay. Maybe I shouldn't use the word illusion. Maybe how shall I put it? Yeah, you know, it's great that the price has gone up and all that. Yeah. But so and you know, you want to hold it for the long term, right? So, you know, we don't know how well Apple is gonna do in the very long run. I mean, chances are, you know, it's Apple being a great company. I also think it's gonna go up. I also think it's gonna go up. But what I'm trying to say, until we press the sell button, you know, we are not safe. You know, so to speak. Of course, if you bought it at a very low price, yeah, then chances are you'll make a profit even if the stock tanks. You know what I mean? Yeah. So similarly for losses, you know, as I mentioned, yeah, even a massive paper loss is an illusion. Like for example, during the crisis, I mentioned that my portfolio was down by 37%, right? Yeah, but yeah, I just held on, and now, you know, I'm in the green. Yeah, but even though now I'm in the green, it's still an illusion, you know. The only thing that I'm realizing are my dividends. Yeah. So, you know, tomorrow, or maybe not tomorrow, but maybe in 10 years' time, DBS might not be doing as well as it is today. You know. Yeah, but and let's say if that happens, you know, touch wood, if that happens, you know, in 10 years' time, for whatever reason, DBS suddenly, you know, tanks, and maybe, you know, I get out late, you know, and I don't sell, I get out late, you know, maybe I lose a bit of money on the capital gain, but I would have made a tiny profit perhaps because of the dividends. Yeah, so in that sense, it is a bit defensive. Yeah.
It seems the problem is that we are unsure as to how to exit a position rather than about realized or unrealized gain.
It's more tricky to exit a position at a good so-called timing. Like if you were to so-called sell Tesla stock as a form of dividend, you definitely don't feel good if it goes up some more, right?
Yeah, so that's precisely, I guess, his point, right? Like dividend, at least you can do nothing about it. It just lands in your account. Whereas if you were to sell, effectively it'll be the same, but
yes.
we just don't know when to do it.
Yes, like yeah, I could be killing the golden goose. Sorry, the goose that lays the golden eggs. If you get what I mean. Yeah. You know, yeah, for example, maybe today I see, oh, DBS is at an all-time high, 36, so I sell it. Okay. And then 2 years from now it's at 40. You know, and all this while I'm not only do I miss out on the capital gain, I don't get I can't sleep on the dividends as well, you know, so yeah, I kind of miss out both. Yeah, miss out on both fronts. Yeah, but okay, when I said illusions, right, what I meant is that, yeah, I mean, until you press the sell button, you haven't realized a single cent if if your company doesn't give a dividend. Yeah. I'm not saying that non pay I'm not saying that companies that don't pay a dividend can't grow or are bad, or
Personally, I
Sorry,
think the
if
main
I can add, yeah, I'm a dividend investor as well, but I hear your points, right? I think the main issue is when you go for dividend investing, a lot of people think that dividend is a defensive mechanism for the stocks itself. But I think most people forget to follow up on the quarterly reporting of the companies. Companies will give you hints of what's happening, and then you then react accordingly. It's not that the company don't give signs. Things like SPH, things like Singtel, all the signs are there. Even First Street, there's signs on there. Just that because people don't follow the events happening, you don't like, for example, First Street. If you read P person, I think 2-3 years ago they already warned that the master lease contract will have issue when it's renegotiated because of the FX that was done way earlier, and it's not sustainable. If you look at the underlying core where they upstream the income, there's only 20% that's enough to pay the dividend, where the whole core, I think is what's that group? Salim. I don't think it's Salim Group.
Lippo,
I
is it?
can't remember
Lippo.
the Indon Group. Yeah, but the Indon Group themselves has been subsidizing. And during the last few years, because the holding group is embarking a big project, One Jakarta, which drain all their cash flow away, it's not possible they can sustain this going forward. It's a matter of time they start renegotiating. So the signs were there, but I think because we are shielded by the thought of dividend, right? We didn't bother to study the company's quarterly earnings or to read around. And also, I mean, just to quote experience from some friends and myself as well, that you think that because you have collected dividend, right? For example, you bought a counter at $1, you have collected 50 cents dividend, right? Even the price pull back to 80, right? In your mind is I'm still up 30 cents. So what if it is down? Currently it's down 20. Next thing you know, right, it becomes 50 cents. Then you say, okay, I break even because I collected my 50 cents. That is the issue with dividend investing, that it allow you into this mindset. So I think the mindset going forward, if you can tweak your approach, right, is to study the financials. So myself, I am as well, but I follow most of the companies when they do reporting to see signs. But of course, having said that, I myself also fall into the trap. I have this counter. I mean, it's even worse than, I think, probably can comparable to First Street. It's called Asia Pay TV. You will see that from 97 cents now it's like 13-14 cents. I got lulled into the dividend trap as well. So but there were signs that the dividend was not sustainable. The yield was very high. All these signs were there. It's just that I ignore them. So I think for dividend investing, you need to fine tune this. Dividend investing, for my experience, limited experience, is very defensive. But the company must have the cash flow to continue to pay, and it's sustainable. So you have to keep looking at the results, the cash flow statements, the profitability, to give yourself the assurance that it can continue. So as long as it can continue, right, it's like a golden goose. You don't need to kill it. The moment some of the things start to fall apart, right, then that's when you activate a sell button. That's how you do your selling. Yeah, not because share price keep running, you kill it. The killing it is because certain sign trigger for you to sell. So even if I don't take profit at the max, but I know that when I take profit, it's because the signs are very obvious now that it trigger me to sell. So don't let the share price be the main trigger point for you to sell.
Yeah. 200% agree with you. I think the fundamentals is is at the core of what we should look at. Not just the dividend yields, because the dividend yields. In fact, the dividend yields could be going up because the stock price is falling. Yeah, so yeah, like what you said, fully agree with you. That we should look at the fundamentals of the dividend paying stocks as well. And like you mentioned, the moment there are warning signs, we should pull the plug on it. Yeah, I agree. In fact, right now I have this counter called CPF REIT. Yeah, and I have a very, 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 very bad feeling about it. Don't ask me why. But I think two CFOs have quit or something like that. Yeah. Their CEO just quit or something like that. Yeah, CPF REIT. The yield is high, but I think I just have a feeling shit is gonna happen for that counter. Yeah.
Can I
but
ask?
I think, sorry.
Go ahead.
Boon Tee, you carry on.
No, actually, I just want to ask you because you mentioned about you also invest in dividends, right? Are you like 100% or invested into dividends? That's the first question. Second question is, do you mainly just invest in Singapore, or you also invest in like global stocks? Yeah.
Okay. I started with more dividend. Actually, I started all over the place. So over time, I actually I'm not young anymore. So over time, I shaped my portfolio to be more dividend based. But I don't focus in Singapore market only. I think during last crisis, just to quote some example. So during last crisis, I think Aussie dropped to all-time low against Sing. Close to, I think it was like a day it went from it gradually go down to about 85 cents to Sing $1. Then it crashed to 80 cents. So that triggered me to want to buy something in Australia. So and I've been studying this counter for a while already, Commonwealth Bank of Australia. So that triggered me to just go and buy because the price also corrected quite a bit. And Commonwealth Bank of Australia is a very peculiar bank compared to DBS and US banks. If you study them right by themselves, if you make a comparison between them and all the other banks, and if you look at Chinese banks, right, they are nowhere near in terms of the matrix. But in terms of dividend payout, right, they are very high. And the other positive thing about Commonwealth Bank of Australia, right, is that if you study the history, then right, they got class action by the pension funds because a lot of pension funds put money in them, so their price cannot collapse too much. There's a certain support level that it will hold. So with that, I actually went in. So I have the FX in my favor, so-called because to me, I travel. So I don't mind using, if let's say I got it wrong, but because the FX is good, I can lock in so-called my travel FX exchange rate in that sense. So I got that position in. So what happened, if you look at the price itself, you will see that it actually moved up quite nicely from that 60 to now, but I exited the position already. So now I think it's about $100. And for the FX, from that I got in at about 85 cents. Now it's about $1. So there's two wins, but this style of combination is a bit hard to hit unless there's some crisis. So just to get an example, you have Barclays Bank, which have a Brexit issue. So pounds actually dropped quite substantially, I think from $2 to Sing to 180, and at one point I think 170 plus. So those trigger some. That was one trigger for me for FX. So the other thing is also because Brexit created a so-called panic, certain panic in the market, in the British market. And the other thing is also because it's a bank, which I'm quite familiar in terms of looking at the matrix. And I know Barclays is undergoing restructuring, which they have not fully recovered since the global financial crisis. They have been gradually nursing themselves back to health. So it's a restructuring play, it's a FX play, and it's also a crisis play. So I took the position. I think it was like 85 to 90 pence in during the period I entered, and you see today is I think about £2. So and FX I think strengthened slightly to about 1.8 to 1.85 range. So at certain juncture, I think certain market, if you keep having them in the watch list, you will have an opportunity. Yeah, so then of late I went into US, but mixed success. I think in my portfolio I have Baba, I have ARC. The slightly successful one is maybe Apply Mac, but now I think it's having a very tough ride. But in terms of fundamentals, is there. So trying to also learn from everyone as well, and fine-tune my approach.
All right, thanks for the sharing. Do you have any outlook for, like, let's say, Singapore banks? Because I think for those who invest in Singapore mainly for dividends, right, they can't get into like banks and REITs, right? Do you have any outlook or any opinion on these two sectors?
Okay, I do have a decent exposure in DBS and UOB. But for me, I think UOB a little bit better value play in terms of the fundamentals. As in, not to say DBS is no good, but DBS I think has the growth element built in their acquisition. I mean, they have a stake in Shenzhen Bank, which I think is a question mark now to me because of the China real estate explosion. So I'm not too sure how big exposure is that Chinese bank having in that area. Of course, DBS also have that India acquisition that they made. But India to me is a challenging market. It's also a question mark to me. Of course, they also have their digital push in their wealth management approach. So they have a lot of growth initiative, but whether all of them will materialize nicely, to me is a question mark. UOB in comparison is also a recovery play, but it's more stable in the sense that because they have been always focusing on SME. So recovery play from the SME angle will help them to build their base very nicely. Of course, the recent acquisition of, pending regulatory approval of the 4 countries that Citibank is selling to them. If you look through the dimension, the matrix of the acquisition, I feel is a very good acquisition for UOB. And I think common understanding, if you don't study the books of the 3 banks properly, you would think that the order of the 3 banks is DBS, OCBC, and UOB. But if you look at the real bank business itself, it's actually DBS, UOB, and OCBC. OCBC was buffered, was inflated because of GE's acquisition, or their huge stake in GE that give them a very high fee income. So that itself artificially make them seems bigger than UOB. So, but having said that, the banks, I feel, has a little bit of overrun now, in my opinion. But for me, because it's a recovery play, I think we can continue to sit on it. But I think for people who are coming in, they need to come in with their eyes open. So likewise, I have the other counteract, because if you see the banks and the REITs, they're actually opposite of each other technically, because higher interest rate benefit the banks, but actually is damaging to REITs. But I think REITs, to me, okay, that the REITs over time, when I shape the portfolio, I have changed my approach. Yeah, what A has mentioned earlier about Sassoon REITs, I have studied them before. I'm not comfortable just to share because first, the sponsor is an individual. His net worth is built because of the REIT itself. So it's not the same likes if you compare with a Mapletree, a CapitaLand, that they can draw strength from the sponsors to pump in capital when required. And also because of the sponsor strength and name, when they go to banks, technically they can ask for better rates. And most REITs with more experience, they have actually learned over time to lock in the interest rate. So not to say that they're totally immune, but what I'm saying is that they have a lagged effect of interest rate rise impact to their business. So during that period, how they shape or change the business that or change the funding structure is something that people need to keep track on. So REITs, there's a few other factors to take a look, like the real of the tenants that they have, but it differs from industry to industry. So for example, data center, just my view, yes, they have very long will of 7 to 8 years. They have built-in rental escalation. But if you look backwards and look at them because of that long will, right? They then behave more like a bond to me. So as a layman, I feel they are becoming like a bond rather than a proper REIT. Whereas you look at the retail REIT, which most of the time, if you are a tenant, you only sign a 2-3 years tenancy agreement with them. And if business is bad, you just fall up and then the deposit get forfeited, and then they have to look for other tenants. So, but the nature, because it's very short term, right, means that they are more mobile. When rates start the rental rates start rising, they also can rise. Whereas a data center does not have this advantage built in them, because theirs is all long term. They lock in everything for you. You see whether the yield is something that you're comfortable with. So today, I think Capital DC is yielding at about maybe 3.5 ish. So to me, 3.5 ish, if interest rate environment start to rise, and Singapore interest rate can go as high as like 2% for retail, then their attractiveness or that premium of 1% right will not protect them from the rising interest rate, and they will correct to maybe 4%, 5%. But because of the correction, right, the price will adjust accordingly. And but today, if I look at the case of industrial REITs, I look at the case of retail commercial REITs, which is recovering. Their yield is also 5-ish%. So to me, in my mind, is that yes, interest rate can rise to 2%, but 2% versus 5% yield. My point is that the premium itself has certain level of protection. So and because of the premium parentage, right, I'm willing to take some bets on them and acquire a small position to generate some dividend. But having said that, if one day their dividend yield drop to like 4.5, 4%, I may choose to exit this position, because the yield premium, right, versus the interest rate, right, will no longer protect the thing in the case of rising interest rate. So yeah, that's my approach for the two sectors.
Thanks a lot for the sharing. Yes, I still have some portfolio SDI ETF, and I also have this data center REITs also and actually it's Mapletree Industrial Trust, but they have exposure to this data center as well. So very good insight. Thanks for sharing. All right. Anyone else have any other comments? If not, we just quickly run through the list, see if there's any questions that anyone want to give comment. If no one want to give comment, I will just skip the questions up. But before we go through there, anyone want to voice anything? All right. This one I think we'll skip. Not really dividends. Better to buy Alibaba or dividend stocks? Anyone or Maximus, you want to comment, because you say you also own some dividends, and you also have some Alibaba shares, right? You want to comment on this?
Okay, I think Baba's issue is I think I shared the chart before on one of the presentation. So I think Xi Jinping never makes his words. He did highlight that he wants to bring down all the giants and spread wealth amongst the industry. So I think in the near term, Baba will still face a lot of pressure. And how they're going to navigate this out, I think that's the main challenge, whether you believe that the management is able to do that. So that is the main concern or the main issue you need to contend with to buy them. But I think I have the other issue with the US listing. So no doubt US and Hong Kong, I realize both are under VIE structure, but US, you have that threat of being kicked out from US listing. So if you do want to take a position in Baba, I would recommend you take a Hong Kong position. And yeah, I think that's the main thing I have on the Baba itself.
Okay, thanks a lot. Anyone else? If not, I personally don't have a view, because I think this is too broad. Alibaba opinions are already voiced numerous times, so I won't repeat that. Let's go to the next questions. How to curb the urge to keep buying stocks on the dip? I have no emergency funds and low savings. Feel like price only go up and better to buy now but broke. This is not really a dividend questions, but since like this week or including last week, the stock market also like corrections, right? So I think it's worth to get into this question. Anyone has any tips for our friend here? Like, do you look at dip and have to buy?
How many percent is the dip?
Sorry, Boon
Tee, Terence here.
Go on.
What I've been doing is I've been watching Disney and Netflix every night. I think that helps a lot. I'm making up time for the lost time last year. So yeah, I've been watching a lot of drama serial even right now while talking to you guys.
Multitask. Any good show to recommend?
Anything that can keep you off the market, I think that will help.
All right. I am watching Witcher season 2. I think not bad. I think the season 2 is better than season 1. Anyone else have any tips or not for these questions?
Okay, I can share mine. Okay, if you think that the crisis is coming, what I previously did, I use a reference benchmark, but I didn't highlight then my benchmark I used was STI, which actually turned out to be not so bad versus if I had used S&P, because I think the movement STI get dragged in by S&P's fall during the COVID. So what I did then was I know the bullets. That means I put 100% mark on the bullets that I have, and I use the all-time high mark, and then I move backwards by 10% to trigger certain percent, and then I move back by another 15%, another trigger. So so when the crisis come, right, actually, if I follow the game plan, I will deploy accordingly based on the risk appetite I have on each pullback. Meaning, like if we move to 20%, how much bullets would I be make available for deployment? And if you follow that, right, of course, depending on risk appetite of different people, I kept some actually all the way to 50% pullback where the last bullet will be used. So if you are very conservative, you could have keep more towards the tail end, like pullback 40% or pullback 50%, then you start deploying. But I think you also have to measure against the probability of this event happening, which is very rare. So you need to balance that. And of course, when you talk about this strategy, right? I think my mistake then was I was only focusing on companies, and companies sometimes, I mean, if you have wide list of range, then it's fine. You can wait for each one to pull back that 10-20% along with the index, and then you start firing. If not, then I think a better measurement could have been that if I wind back and redo again, I could have used just BOO SPY as the reference point, as in when S&P pull back by 10%, I just fire one round into this index instead of stock picking and having the fear that, oh, I buy this and then the next day, like I think TBS, if you have follow, I think this morning I mentioned the crash when it happened, right? It's really you keep firing until you kill yourself, get scared because your trading limit got all used up, and you call your broker to lift the limit even higher. So that those are warning signs that trigger that maybe you should take a step back, these sort of things. So I think on hindsight, if I have used the index way of firing, right, it may be a little bit more stable, as in because you use the benchmark at 10%, what is the value, and then you trigger. And then the 15% mark when you trigger. So plus minus 1% is not so bad. And the trigger can be fired quite easily. Whereas if it's individual stock to do that trigger, right, I think it's a little bit harder. Yeah, I think basically that's how I would done it. But if I hear someone who say don't have much bullets, then well, maybe the strategy is just to change it to squeeze out 3 bullets, and then you just fire based on certain reference point. And then like maybe, I mean, if it's 3, maybe I would done 15%, 20 and 25% pullback. But of course, it may not happen. Then the bullets are never used.
Yeah, I think very detailed strategy. And I think my main takeaway is that regardless of what is the strategy, the most important one is to have a plan, right? Like you can do it based on the price level. You can do it on the single stocks or at the ETF, but you just need to have a plan and then maybe just submit the limit order and let it execute if it hit the price level. If it doesn't hit, then just be it. Then you also don't have to do anything, right? I think that's a good plan. Any plan is better than no plan at all. But for me personally, I would say like I'm not buying, right? I think you guys also know if I make any purchase, I will inform in a group. I'm not buying. For me, it's like every month, second of the month, I will put the money into the brokerage account.
Yeah, I have a question. Anyone here looking at Mapletree Logistics Trust?
Okay, I didn't really study big time into this, but I just want to qualify that Mapletree Logistic Trust, because of the word logistic, is a little bit misleading to me. Because if you look at a logistic business versus a normal, typical like Mapletree industrial trust, they are not significantly different because so the logistic business is also a warehouse. The only thing is it's more organized in terms of they let the logistic business put materials down there, and then and because of the lease arrangement, the service built in, these sort of things, and the lease agreement, they then command a premium versus the industrial trust. To me, I feel that premium can be easily eroded if today you have someone who goes into the industrial trust and revamp part of their business to change. So, which is what Mapletree Industrial Trust is currently happening, where you see they start to build a portfolio of data centers, which they see value in terms of the stable cash flow to build into their business. So I think that's one thing. The other thing is, if you look at the price to book value of the various trusts, I feel the premium given to Logistic is a little bit more expensive versus the industrial trust, which I feel that the gap isn't really warranted. So if all things being equal, let's say the price to book quite similar, the yield quite similar, then the will will come into the picture that a longer will create a little bit more stability for the business, especially if you are heading towards a downturn. Then that itself will be more defensive in that sense. So long and short is I have position in industrial trust, but not logistic trust.
Okay, thanks for your insight. Thank you.
But having said that, I qualify because it's a Mapletree name. I like this sponsor, so I will not say you should sell, but I think as long as Mapletree is there and you feel that the yield is something that is acceptable to you, I mean, it's something that you can hold because come crunch, right, you know that the sponsor will come out with money to help them to tide over, and they just need time to come back again, which was the last crisis that hit them a little bit badly. I think it was during the 08-09 period. So I cannot remember Logistic Trust were they listed then, but I remember Logistic Trust had a very bad time because then they were as of now as well, that they were a premium to their price to book, and then come that crisis, right, the whole thing corrected to be a discount, I think 0.7, 0.8 to the book value. So that itself need to be a bit careful when crisis come. But today's crisis is a little bit different from the last crisis. I think the last crisis, the valuation dropped tremendously, which create a lot of strain to the REITs itself. So I think today's REIT, most of the other thing you need to look at is the gearing. And gearing, do remember that the definition is a little bit different from the traditional book definition, meaning gearing is borrowings over total assets. It's not the borrowings over equity. So you talk about 50%, right? It's actually one time if you look at the traditional way of doing gearing ratio. So you just need to be mindful of the terminology used. Don't be lulled into the part where, because they are 50%, so if they liquidate, I will still have half my money back in the worst case scenario. It's not true. I think if you can get back something, if they fully liquidate to pay back the banks, right, you are having is a blessing already. Which I think for Eagle Hospitality, I think that was that's a mix of both. That first the valuation is inflated hugely, and then of course there's a lot of fraud inside that case where I think even the first investor didn't even get a single cent out from the Eagle Hospitality Trust. So I think these things are things that you can study and pay some attention. But I say if you use premium name as the first line of filter, right, you can't go very far wrong.
Yeah, I understand. Actually, I was looking to enter it. I don't have a stake in it yet. But with the rise in e-commerce, I thought that MLT would be a so-called beneficiary to the e-commerce trend. Yeah, I actually have the wrong Mapletree REIT. I have MNACT, which was bettered, because of the Hong Kong riots, etc., etc. Yeah, but fortunately they are gonna merge with MCT. Yeah, Mapletree Commercial Trust. So I would be still slightly underwater even after the merger. Yeah, but at least I managed to recover a bit.
Yeah, I think I hold MCT by the way, so I'm your opposite. So, but this period, I think till June, having gone through the CCT and CNT, the two REITs, the fortunes are so-called linked together and by the formula until this whole transaction is over. So I think this period so when two things are linked together, you need event to benefit either side to move it, or event that do not benefit any side to move it down. So that is the issue when such transaction is happening. And I think for me, I'm sitting through because I feel the acquisition helps to improve the yield, give more so-called avenue of growth for MCT. So to me, I have no big issue with holding my position, even though it has pulled back a bit from I think the announcement. I think it was like $2 before the announcement, and then now it's like 185 thereabout. But I think for MNACT, the advantage is that now the concentration risk on Festival Walk is no longer that huge. I think, but people compare that Festival Walk to VivoCity of Mapletree Commercial. So I think as a whole, both parties will benefit from this merger itself.
Yep. As an MNACT REIT holder, I feel quite lucky actually. Yeah.
All right, thanks for the comment. Shall we come back to this Q&A, because I see there's a couple of questions that's quite interesting. Okay, let me read out, but just all the other questions I'm not going to repeat. I guess you guys get my point now. Okay, let's go through this one. Growth stocks much better, as you could sell a stock when needed cash, avoid USA tax 30%, and helps to maximize gains by invest back into business. I think my personal view is that yes, that's true. Growth stocks, because you can sell the stocks whenever you need the money, right? So they are technically liquid. So you don't really need a dividends to have a liquid cash flow. You can actually control by deciding when to sell, right? The only risk is that you don't know. For example, like you need the money 1 year later, but the valuation might not be at the level that you like. So that's the risk that you are running if you just mainly hold on to growth stocks and use that to fund your liquidity needs, right? So that's one point. The other point is that I think for this 30% withholding tax, I do agree. Let's say if you say you are investing into US stocks, I think dividends is never a good idea because of this 30%. It looks good before the tax, but after you pay the withholding tax, 30% cut is actually quite significant.
Sorry. I agree that this 30% dividend tax. Yeah, I agree that it's quite I guess if I was taxed 30%, I would probably not wanna buy dividend stocks. But in the Singapore context, it's tax free. So I don't quite get this point. And also, growth stocks much better, as you could sell a stock when you need cash. But if I'm holding on to a dividend stock, I don't even have to sell it if I need cash, because I'm getting the cash through my dividends. So I'm not too sure about the point here. But anyway,
Yeah, let me explain a bit. I think I also don't think that just because growth stocks you can sell, then it become better. I'm not saying this is the logic. because for dividends, you can get the dividend cash flow and you can also sell it, right? So just the fact that you can sell the stocks cannot justify to say growth stock is better. I don't think this line is true. It's just that I think my interpretation is that because you anyway can sell the stocks, so whether you get the cash flow through dividends or not is not so important. Like just now in the beginning of the discussion, we also mentioned, right? You can sell a small portion or you can sell the entire portions. So you don't really need that cash flow as long as you are able to sell, right? You cannot say the same thing for, let's say, real estate, right? Because it will be very costly just to buy, sell real estate, physical real estate. So I think that's the point. And then that you also brought out a good point, is that if you invest in Singapore dividend stocks, you don't have to care about this withholding tax. So that's also a good point. I'm just trying to bring out the point that for US stocks, dividend is not a good idea. But for Singapore stocks, dividend is a viable option, right? Yeah. It really come back to the preference, not to say which one is better.
Maybe I add another angle to two angles actually to this. I think the whether is it dividend or growth investing, right? When we say we need cash, what if the market is not like current market situation is bad, these are things, and then you have to look sell at a loss. So I think one of the thinking that I came across some books or even pension fund, what they recommend, it may be too extreme to have certain like cash holdings, meaning you will cash drag your portfolio. But I think if your portfolio is big enough, what's like 5%, 10% into cash, more liquid assets, like people, some advocate like 6 months. But actually the pension fund I studied, I think California pension fund, they actually keep 5 years of cash in bonds. So any crisis, in their opinion, right, they can fully invest the balance. But any crisis, in their opinion, 5 years is more than enough for them to tide over. And if the so-called 5 years of reserve get depleted, right, then they go into their stocks to liquidate the position. But if the 5 years is not enough to tide them over a crisis, right, then the stock's value will have recovered or even go higher. Then they liquidate whatever position required to replenish the 5 years, and then they go the whole cycle repeats again. So these are things that I feel, but subject to individuals' circumstances, you can do this strategy accordingly.
Yep.
Then the other thing, maybe I just want to raise is, I guess because yes, I agree that US dividend play is not really a good play because of the withholding tax. But in my mind, there's also the other part twist to it. So if you look at this is a little bit on hindsight, but if you look at cases like ExxonMobil, during the crash of the oil price, they try very hard to sustain their dividend without cutting, because they do belong to the old traditional dividend aristocrat. Their dividend went as high as 7-8%. So not saying that it's a good time to enter because of the oil price crash, and then they were struggling because they used borrowings to fund the dividend, to continue to fund. So if the market don't turn right, gradually, I mean, it's a matter of time they have to sacrifice the dividend to maintain a reasonable cash flow to run the business, and rather than keep expanding, use borrowings to fund this payout. So when the industry start turning right, in my mind is like, yes, I know, let's say, for example, the oil price from that, I think as low as like, I think was negative at one point, the futures. Then it started to move up from 30 to 40 to 50. At the juncture, right, if you use a dividend play to angle yourself in, right, meaning with a 5% or maybe 3-4% post-dividend, post-withholding tax, because of the lower price, that provide you with first a defensive mode and on something that is recovering. And when because you're on something that's defensive and recovering, right? Your so-called your upside is much more than downside, and your percentage of certainty of return, right, is there. To me, I highlighted I think there's also stats showing the certainty of return when you have 100% certainty to get $5 versus 1% certainty to get $1,000, right? Certain people, I mean, you do it in terms of the expected returns, right? Sometimes the expected return for that 100% certainty, right, is higher than the projected return on something that is the probability is lower. So dividend pay, yes. While US could have that withholding tax pullback, right? But if you weigh against this, that means you have certainty that things are recovering, where the cash flow start generating more and more, that is able to fund their capex and fund their dividend, right? As a turning point, right? Then it's something that you can actually do the play and benefit from this upturn. So I think opportunities is always there. It's just a matter of what suits your risk appetite and how you position yourself for such event. So I think Singapore end, I played CapitaLand, where I think the price was at 270 languishing, and then but the traditional dividend was about 12 cents. I know it will cut. So, but if you use 12 cents against that 270, you have about maybe 3-4% as a buffer to give you that comfort while waiting for a catalyst to happen. And so happened that they privatize the thing or they restructure the thing, and the upside suddenly or the catalyst just suddenly release, and then it just bounced. So that itself can be a so-called fortunate play, but while fortunate, I'm waiting also, I have the dividend to pay myself while waiting for this to happen. So I think different strategy will provide different result, but provided you, I mean, I don't advocate single strategy. I think we should play different strategy with certainty of some, with so-called expected returns for some. So I think DBS had that barbell strategy that you put very high risk asset at 10%, and then the 90% shows very strong or stable returns. So that strategy is something that I think in today's discussion, something that we can adopt. So not saying that dividend is good or growth is better, but I think a mixture of both can coexist when opportunity comes.
Yeah, actually, I agree with you on the second point that you mentioned, right? Because I'm always thinking like, okay, if I see this as a long-term play, right? Do I want to own, let's say, like ExxonMobil for, let's say, 20 years, right? I would say that, okay, if that's the case, and if this company is paying a lot of dividends, right? Then basically you need to account for that 30% being paid to Uncle Sam. Then you only get like 70%, right? That's true. Look at it from a long-term whole perspective. But let's say, like you say, right, we only like want to play this recovery trade. You just want to hold it, and you think that, okay, it could like take 6 months or 1 year or even 2-3 years to recover, right? For that short period of time, as long as really it play out and it recover, right? And you can just sell off that position and close it. And from that point of view, actually the 30% is not a big problem, because you only hold it for like, let's say 3 years, right? 3 years, you just take the dividend percentage, multiply by the 30%. You actually just pay a small percentage to the government, to the US government. The problem of that 30% become a huge portion is when you treat this like, I'm planning to hold this for like 10, 20 years, then it become a big problem, right? So it's true that, yes, we don't really need to like fixate it to just one strategy. There could be different strategy, and some you want to play for, like, let's say, recovery is always not a big problems. So I think the framing part is very, very important. And I do agree with the point that you just mentioned. All right, let's get through like I think 1 or 2 more questions. I think it's also late already. That's the thing, right? We start like late, so can't last very long. Who else is there? Was still quite a number. Yeah, I just want to hear the thought on these questions. Growth stocks are trend nowadays. Dividend stocks are for boomers' mindset. But this is not a statement. It's a question mark. Yeah, Maximus or A, you have any comment on this?
He can't even spell boomer correctly. Definitely a boomer who asked this question.
Yeah. Or boomer means something else.
Yeah, I think I earlier highlighted, I think different strategy as long as I think key is making money and you have that certainty. So whichever strategy you adopt, as long as you do your necessary homework to have the conviction, I think that's fine. The worst thing that will happen is you just blindly follow, and that's where you don't have conviction, and when price collapse, right, you just hit for the exit and realize your loss. I think that's the worst.
I think I can understand more on this question if we discuss this, let's say, end of December, let's say November period. I think this statement will be like, oh, okay, I get it. Because the growth stock has been doing well, right? Then you say it is trendy, who want to buy dividend stocks, right? But now it seems like a bit weird when this question come out, given that, let's say, all these growth stocks has dropped so much, right? Even, let's say, like Netflix dropped by, I think, 40%. C Limited dropped by how much? 40, 50%, right? So this one is already like maybe a bit irrelevant. Okay. Next one. What's the point? Okay. What's the point of dividend stocks when inflation are literally 7% in the US? I guess this is the same person because a lot of like spelling error. Dividend. Quite interesting. But any view? Just want to hear some reaction.
Then I could also say, what is the point of investing in is Netflix a so-called growth stock? It is, right? So what was the point of investing in growth stocks if inflation is 7% and now you mentioned, what Netflix is 20% down. Now, my point is, it is not about growth or dividend stocks, but I don't think his point really makes sense. Yeah, because inflation is 7%. Yeah, but I guess what he means to say is that if dividend yields are less than 7%, then what's the point? Yeah. But yeah, I don't think. So does that mean if Netflix crashed by negative 20%? So does it mean we don't touch growth stocks, or yeah? I think it's a bit too
Got it. Actually, I noticed this question all come from the same person. Just from the style, I can tell, but I don't know who. Let me read out all these questions first, and then we see how we will respond. During a bear market, wouldn't dividend stocks get hurt more as company hands out money? Dividend stocks are still considered similar risks as compared to growth stocks like Microsoft, Apple, and Google. And then there's one: how to sleep better knowing that inflation is 7% while holding dividend stocks? I think these are all same person. You see the dividend is the same spelling everywhere, right? So if you have any comment, you can comment. If not, we just jump over.
Maybe I just share my view. I think inflation, right? Yes, we know inflation. So, but inflation will benefit certain industry versus others. So if you know the fundamentals of the industry, you may be able to take advantage of this inflationary so-called happening in the industry. So, for example, industry like we talk about supply chain management having a very bad issue. Today, you talk to the so-called previous sunset industry of the containers. Previously, they were like everyone is saying that they cannot make it, all will die. So Singapore even sold off NOL. But today, the same business itself is making a huge profit because of the supply chain situation. So if you want to play situational play, then look for things that will be inflation is beneficial to them. So a case of, let's say, if inflation is from real estate itself, so real estate companies will benefit from such issue, because the properties they sell, if inflation is high, means they can sell at even a higher price, and that will benefit into their P&L, because things are bought before this inflation happened to them. Then there are other industries that will suffer. So end of the day, I think the key is looking at the fundamentals of the company rather than to see whether is it growth or dividend. And I think the key is to look at the fundamentals to see how such macro factors affect the company and whether the company can have a way to navigate against this.
Yeah, definitely true. We tend to generalize a bit too much, right? Like just say, oh, because dividend stocks, given that if like Apple is paying dividend, let's say Singapore REITs is paying dividend, they are not the same, right? We still need to come back to each company's, look at their fundamentals and have a more, let's say, like a detailed discussion rather than keep on generalizing. Yeah, totally agree with you. Yeah, I'll just go through this one fast. How fast will Fed rise interest rate yearly estimates? This is very specific, asking for yearly. For example, like 1% per year. I can only share that, you know the tables that I shared from the CME website, right? That one, they can tell you, like, let's say 1 year out, even until like first month of next year, right? I would say that usually they are quite accurate if you just look at the probability, because that's how that is the market rate, right? The implied probabilities, right? And the latest one that I have seen is already pricing in 4 to 5 interest rate hikes this year, meaning that interest rate will go up by around 1% or slightly more. But that's only up to a year. Longer than that, actually, no one can tell, because inflation can change a lot, the GDP can change a lot, unemployment can change a lot. So really, even if you have a numbers for, let's say, 2 years, 3 years, right? Very hard to say it is accurate. But that's the implied probability of rate hikes. But you can always look at the dot plots that is provided by Fed. So they have this chart. I think that they are showing, let's say, 3 or 4 years projection. I mean, take that as a reference, but that is not the market rate, right? It's just some, they just give their expectation on where the short rate is. So you take that as a pinch of salt, because if you don't agree with that dot plot numbers, right, you cannot actually trade against it. So meaning that it's not a market rate. So with that sense, it is just like good only for reference, but don't take it too seriously. So that's my answer for this question. Anyone else want to comment on this? If not, we jump. I think this is more important. Let me read out the questions. As cost of capital go up, won't dividend stocks and REITs suffer? I think this is slightly similar to the previous questions. But Maximus or A, do you have any comments on this? Additional comment?
I guess cost of capital, main thing is like I mentioned before for REITs, the interest rate structure that they have structured. So I think in the REITs report, they will keep highlighting that how much of their capital has been fixed. So a REIT can fix it with banks on a 5-year basis, 3-year basis. They can also do from the bond market on a 5-year basis. So these are things that they can lock in the REITs to insulate themselves from this higher cost of capital. So the premium names can do it better than the lesser premium names. So that's why my earlier emphasis on premium names. Yeah, I think that's more or less what I would say. Then for companies, I think you also have to study how is their debt done. So not to say that companies like Microsoft, Apple do not have debt. They have. But the thing is, if you go and study their balance sheet, right, their debt is a way that I think the company think they can, because of their financial status or financial muscles, they can get a better rate from institutions. And with those rates that they, let's say they are AA or AAA, they go and then use the money to invest in maybe a A-rated but equally so-called good company in their view, and do the interest rate arbitrage and earn extra income from there. So I think for Apple, Microsoft, the giants, right, they actually while waiting for opportunity, they also use such instruments to improve the earnings or at least give them more so-called tidbits along the way while waiting for the biggies. So I think the leverage thing has been a little bit overplayed. So just have to look really into the company to understand the structure and then appreciate how the company do their business based on the cost capital. The capital cost available to them.
Yeah, definitely agree with the point that you just raised. I remember even for companies like Netflix, they are also raising debt in the past when they are running on negative cash flow, right? Before they actually turn positive, they also rely a lot on the debt. So I think not to say every tech companies are like having low debt, right? It might not be true. So each one is different. Totally agree. Okay, let's see a couple more. This one, I'm not sure whether this is a dividend related question, but let me read it out from Mr. Fu, and he has two questions. I'll just go at one go. Is CPF SA the best safety net for guan coffin money? And the next question is, dividend stocks worth it as they are also not totally immune to capital depreciation, share price drop? I think this is interesting questions. Any viewpoint?
Okay, the dividend, the CPF special account, I think I have the strategy as well. But I guess it's whether how you want to play, whether you want to do a legacy play or you want to do a cash flow play. So CPF is actually designed to for retirement. So if you want to do it as a legacy play, then it's a very different play. I think they have closed some of the gaps in the recent revision, whereby the interest you earn, you have to all exhaust your special account before touching the ordinary account. So I think the CPF is also concerned that people are using that as a legacy play. So I think if you want to use that you have to plan it at 55, how you intend to do it. So that post 55, right, you just go along with the strategy. Like for my case, I'm thinking of just a twin engine of a RA and a special account and empty my ordinary account. Because special account always block the ordinary account from being drawn out, and it's a lower interest instrument.
I think CPF related questions can have entire like a separate session. This is not something that's easy to understand. Like even I am in the 1M65 group, there's so many CPF questions, right? I look at those questions, I also like totally lost, very, very difficult to me, it's even more difficult than stock investing, because of the rules are too complicated. Yeah, the second one, Maximus, any viewpoints on the second one? Like dividend stocks, even though we say it is more stable, right? It's true that share price also can drop, right? Be it growth stocks, even dividend stocks also can drop. So would it make it more immune? Yeah.
No, I think we shouldn't be too. I guess it depends on your. For me, I think the key is whether you do it as a core or as a satellite, meaning a tactical move. So tactical move, like what I mentioned earlier, Exxon was a tactical move, CapitaLand was a tactical move. But a case of REITs, right, it could be a core move. Until, like, for example, the yield drop to a certain level that is it's better I take a risk with putting the deposit. Let's say it's using deposit give 2% and then the REIT is giving only 3% or 3.5%. Then the risk premium doesn't commensurate the me holding the REIT forever. So if you use that viewpoint, right, then you wouldn't keep looking at the price to see or to be too disturbed by the price movement, because it's actually a long-term play or even a cash flow play. that as long as it continue to generate what is required and things it's a temporary event triggered situation, right? Then one day you will come back again, and then your cash flow may be disrupted for a short while, and then you'll recover. So I guess key is to know what you're buying and not be affected by the market situation. So having that reserve is also important, that you do not have to panic sell when the market is crashing.
Thanks for the comment. Okay. Is it?
Sorry, Maximus, I have a question. What's the equity risk premium you look for when it comes to REITs?
Yeah, just my view. My view is actually REITs. I use yield as the main focus to exit a position. Even though if it's a premium play, but if the yield becomes too low for me, I will still take the exit route. So a case of I think Mapletree Commercial, right? If you trace their history, there was a period where they run very fast. So I think from a case of 180, they ran all the way up to 240. At 240, right, the yield is actually 4%. I computed. So to me, a REIT at 4% when I put in a high yield savings account which yields 2%, right? I feel the risk is like not really worth taking that punt. So I retracted my capital and then just put in the cash deposit and just wait out. And then, I mean, maybe lucky for me that the crisis came and then the whole price pulled back and then I reload my position again. But I think for REITs, yield is a trigger point for exit. It's a possible trigger point. The acquisition, whether is it earning accretive, that is also a trigger point. So meaning if the REIT keep buying so-called value destroying assets, then it's also a signal to you that maybe the owners are trying to offload their so-called not so attractive assets into the REIT and then cream off from the stakeholders. I think Sabana is one of the cases that was highlighted earlier on such cases. And I think the other thing is for REIT, you also need to look at rental support. So rental support means they tell you that the price is worth this valuation because going down the road, the rental is, let's say today is 120. They feel that the rental down the road, 3 years down the road is 150. So they give you that rental support to support that situation of 3 years down the road, which may not happen. So when that rental support disappears, right, your yield suddenly drop. So these are things that you should take a look at. And okay, I'm digressing a little bit more, but one other case that you can see is REITs today have development projects, the bigger ones especially. So Keppel itself, Keppel REIT, if you study them, they had one big project earlier on where they built that police station in Australia. So a case for them is that you look at the price to book, right, it's very low, as in 0.9, 0.8. So it should trigger you to then look what happened, what causes this, and then you see that project happening. And how you can position is that maybe 6 months, to a year before the project materialized, you can start positioning your position in to benefit when the whole project is completed. And I think Ascenders also have one where in July they built the whole building for Grab, and that itself will create generate certain income, additional income to them. But these are things that has been done over the last 1-2 years, which is not seen in their books now. So these are things that's why I say we focus on the fundamentals. We know what are the events that's happening, and we mark down those events to then have a better feel on the cash flow coming in, and to then have a better gauge. That means when I say yield of 4%, I already included the forecasted dividend that's coming in. And with that, if it's 4% means at the current price is even more inflated. So these are trigger points for me.
Okay, thanks.
Thanks for the comment. I think it's late already. We have a couple more questions here, but I don't think we have to go through all of them now. Anyone who is still on the line, if you ask any of this question, you want us to go through it, let us know now. If not, we will just give the last comment and then call it a night now, because it's late already. I noticed that some already left the chat. Anyone else? Or any closing statement from Maximus or A?
No, I have none, thanks.
All right, then I think we reached to closing statement from Maximus. You want to say anything? Because I don't think we will go through all of them now. If not, we'll talk until like 1 o'clock.
Oh, nothing for me. Sorry, I take a lot of your time.
No. I think
just sharing only.
I think that's the things, right? We were having this discussion. It's not like really doing homework, need to answer all these questions. These are really just to assist our discussion. But I do think that today we have a very good discussion. I think I would say, at least for me, myself, I do agree with almost all the points that